This segment is brought to you by the Rare Coin Bullion Exchange and the IRA Advisory Group. Hello, everybody. This is Patrick MontesDeOca with Equity Management Academy. We have the great pleasure and honor to have with us today John Embry, Chief Investment Strategist of Sprott Asset Management. John Embry joined Sprott Asset Management LP as a Chief Strategist in March of 2003. He plays an instrumental role in developing the corporate and investment policy of the firm. John, an industry expert in metals, has studied the gold sector for 30-plus years and accumulated industry experience as a powerful portfolio management specialist since 1963. Welcome to Trading Talk, John, and a very happy New Year to you.
Happy New Year to you, Patrick. It's always a pleasure to chat with you.
Thank you, sir. Moving right into our first interview of 2014, the 10-year note is holding steady about 3% yield so far. Has the tide changed for interest rates, John, and where do you see rates going in 2014?
Well, I do believe the tide has changed quite dramatically for interest rates. I mean, they should be much higher already, but because of some very, very arcane derivative strategies, various spreads and swaps and what have you, they've been able to hold the rate on the 10-year at around 3%. I mean, if you look at the true fundamentals, if the possibility of ultimate default or ultimate inflation rates, you're not getting paid for the risk you're taking in owning U.S. 10-year or any U.S. paper for that matter, but we'll just concentrate on the 10-year. So I think that as time passes and more of the foreigners realize that this is not a good investment, the Fed's going to have to continue to buy more and more of this paper, and at some point the rates are just going to go north because people will realize that there's no real intrinsic value in it.
Mm-hmm. Mm-hmm. How could higher rates impact the debt and interest rate payments on the U.S. economy, bonds, real estate, Main Street? Just moving forward from here.
Yeah, well, that's an excellent. Well, I think that's the real question, and I think one of the reasons why they've gone to such great pains to pursue this zero interest rate policy and they hold the 10-year bond to the extent they can. You got to remember that the yield of the 10-year bond virtually doubled from the lows last year. It was down around 160, and then it got up to 3. Yeah. But you see, at some point, these higher rates are going to have an unbelievable impact on the debt. But importantly, the impact I think it will have on the derivatives and the loan books within the highly levered banking system. Mm-hmm. That's what I think they're trying to protect, because if interest rates were to move up, just to take a number, let's say they were to double or something, or move up 200 or 300 basis points, I think the banking system would be under enormous stress, and the world would look a lot different than it does today.
The government data points to the Feds that basically they have won the war on inflation. Your comments on that?
Well, I think the inflation numbers that the U.S. reports, and they're not the only ones that are cheating on their inflation numbers, are simply wrong. There's a chap, I'm sure you're familiar with, John Williams at Shadow Stats, who's gone back and sort of recalculated all this stuff basing on the original methodology before it was, changed to make things look better. Right. And I suspect that the real interest rate is very, very much higher than the current one. And this has a number of impacts, because you got to remember, when they report nominal GDP, it's made up of inflation and real GDP. So if the inflation rate is in fact as high as I think it is overstated. I mean, so the real growth of the U.S. economy isn't what they've purported to be.
Sorry, I'm sorry, John. Can you repeat that? I think we got a little technical issue. If basically the nominal GDP in the United States is made up of inflation and the real GDP growth, and if inflation is being systematically understated, by definition, real growth is being overstated. And I believe that to be the case. So I don't think the Feds have won any war on inflation. If they continue to print the money, I think they're going to have to. There will be an explosion in inflation at some point when the velocity of money accelerates. John, is the economy strong enough for the Feds to increase and continue the tapering strategy, or do you think the Feds have still the control on monetary policy, or have they lost complete control? Well, I would start by saying no, the economy is most certainly not strong enough for the Feds to increase
and continue the tapering strategy for the simple reason that it would imply much higher interest rates, and that, as I said earlier, would have a huge negative impact on the economy. I think the Feds basically have lost control of monetary policy, and this will become more evident as the time goes on. I foresee the economy weakening in the not too distant future, and the tapering strategy being a band creation just to keep things together.
Where do you see the stock market in 2014, John?
Well, that's the really tricky question, because if you honestly believe, as I do, that they're going to have to print more and more money, one of the, places where the money will go is in the stock market, because in many instances, stocks represent real things. What I'm more concerned about are bonds, bank deposits, and that, which I think the purchasing power will be rapidly eroded. But having said that, the sentiment in the stock market is so bullish, and some of the individual stocks are so elevated based on their fundamentals, and I don't see the fundamentals improving because I don't think the economy is going to be there. So I think there's extreme risk in the sense that you could have a flash crash or something in the stock market. But in the end, if I'm right and monetary policy becomes more and more expansive to sort of fight off the possibility of financial collapse, a lot of stocks are, there's a lot of stocks that I would be inclined to own in that environment. But I think it would be you have to be pretty selective.
Let's shift gears a little, John, and talk about your expertise subject matter, which is gold. Can you give us your perspective on the transformation that's taken place in the gold market the last few years? And have you ever seen this type of environment between the paper and the physical market in all your illustrious career?
No, that's an excellent question, Patrick, because, I have to tip my cap to the guys on the other side, the people who are controlling the gold price with the paper market, because there is a complete split now between what's happening in the paper market and what's happening in the physical market. As you know, massive quantities of gold are headed for China and Russia and other places in the Far East, the Middle East. Turkey's had huge increase in their imports this year, and a lot of that's being routed to the Middle East. And at the same time, despite this rapid growth in demand, the price has gone down because of what's been happening in the paper market with derivatives and short selling and everything. And I have a very simple philosophy. If they continue to put pressure on the paper market, which they are continuing to do right up to the moment we're speaking here, it's just going to enhance the ultimate physical demand. And I think the West is going to be, and the Western central banks are going to be cleaned out of virtually all their gold before this is over. And when that moment arrives, then I believe that the people that own the gold, the Chinese, etc., will mark the gold price up. So I basically have never seen anything quite like this, and I think in the fullness of time it will be seen as a massive mistake by the Western authorities.
Will China's record exports continue?
Record imports or exports?
The record actually exporting to them, they're importing the metal. The record imports.
I believe that, it will come and go, but I think China basically, because of their overhang of, trillions of U.S. dollars, will use every opportunity to buy hard assets anywhere in the world, be they gold mines, oil companies, physical gold. They are just going as fast as they can, offloading U.S. dollars to buy real things. And they've always had they have a gold culture over there, and so consequently, I expect them to continue to buy as much gold as is made available.
Is that because you think they're back in their currency with gold, maybe in preparation to move away from the U.S. dollar as the world's reserve currency?
Yes, I'm afraid, and I say this with a great deal of sorrow. I'm a Westerner, and I've liked our lifestyle over here and our values. And I really do believe that this is their plan. I think the U.S. is extraordinarily vulnerable with the debt position in the United States and what is unfolding there. And if China ends up with all the gold, there's one adage in history is that gold goes where the wealth is being created. And it's certainly leaving the West and going to the East, which tells you a lot. And I really do believe that the Chinese have every intention of backing their currency with gold and usurping the U.S.'s role as a reserve currency. I have little doubt of that, actually.
John, this question came into my mind right now. Shouldn't the U.S., with such a high debt, level be buying gold or having their currency be backed by gold or silver instead?
I would say absolutely yes, but for some reason we've developed a culture in over here where most of the Western countries have gotten rid of their gold. Like as you know, I live in Canada.
Right.
We disposed of virtually all our gold, our official gold, years ago at around $400. I mean, and so did Australia, and the English have sold the vast majority of their gold. And I do believe that most of the Western central banks have clandestinely gotten rid of their gold through leasing and swapping. And I think probably the real tell on that is this whole German issue when they came and asked for some of their gold back. And they're not getting virtually any. So if you basically it was there, they could put it on an airplane and they could fly it there in a week. But it's a few dribs and drabs come out. So my conclusion would be there is no gold. It's gone.
Will gold still shine in 2014, John, or should we expect the same kind of manipulation? And do you like gold or silver better?
I believe that before 2014 is over, that this whole Ponzi scheme in the gold market will be revealed, and that gold will more than shine. It will move up dramatically. But that doesn't mean the timing of this is imprecise. Like right now, they have as effective control over the gold price with their paper shenanigans as they've had for the last 28 months where the gold price has been under pressure. I believe that will change dramatically in 2014 when the physical market sort of ascends and takes over the pricing mechanism from the paper market. And in that event, I believe that silver, as much as I love gold, and I think everybody should own gold because it's the real money, I think silver is sort of poor man's gold. And when the gold price ascends to levels that the average person really can't go out and buy much of, I think they will focus their investment intentions on silver. And because the silver inventories in the world are minuscule, and that 75% of the mine supply is going into real, growing industrial uses and a lot of high-tech stuff, I think silver will outperform gold. And it's been a historical ratio, gold-silver ratio. Right now it's very elevated in the sense that it's about gotten as low as 15, 20 to 1. And if that happens...
It's around what price? I'm sorry, it's around the 60s?
It's around 60 to 1 right now, but it's been as low as 15 to 1. And I suspect we'll move in that direction. So you don't have to. The maths are easy. I mean, if gold say went to $3,000 and the gold silver ratio fell in half, well, the silver would go up over fivefold. So I mean, I do think, as much as I like gold, I think silver's the real home run ball in that sense. You're going to make more money with a silver position than you will in gold, but I think you got to own both.
John, what do you make of the precious metals mining sector, down more than 50% for 2013? Is this a buy, or should people stay away from it?
Well, it's fascinating. If I'm right, and I believe I am on my calls on the bullion prices, I mean, I think that the mining sector is probably the greatest buy in its history. I know my partner, Eric Sprott, who's been a fabulous operator in the stock markets for 45 years. I mean, he thinks there's a number of gold and silver stocks that can move up 30 to 40-fold as a result of how depressed they are and how far that we think the prices of gold and silver can go up. I would dare say, and you have to be selective because the companies have to have the ore bodies and what have you, and they have to have the balance sheets to survive through this difficult period. But a well-selected portfolio of gold and silver shares at this point, I think, will be a spectacular investment. And I think you can just basically dollar average in here because you don't quite know where the bottom is. I think we're very close to the bottom because the values on these stocks are preposterously low in a historical sense. So yeah, I think it's a great opportunity to, particularly if you don't own any. I mean, problem is that so many people got in and then they've been murdered in this sector, and now they don't quite know what to do.
How can higher interest rates affect the mining sector?
I think that if the higher interest rates are accompanied by materially higher gold and silver prices, it will be a minor irritant. I would think that the impact on the rest of the economy and the rest of the market would be such that the mining sector would stand out as a shining example of something you should own.
Where are you putting your money in 2014, John?
Hard assets. I mean, basically, I don't want anything that's paper. And I think that I think there'll be a reset of the financial system and the monetary system, and what you want to sort of get you through that is, real things that are tangible and can't be replicated easily like money can be.
Any additional comments you would like to make as we start 2014, John?
Well, I just make the observation that you got to be careful about what you read in the mainstream press, because a lot of it isn't news or it's propaganda. And if you basically are following a conventional portfolio approach, I think you could get badly hurt if my view in the world comes to pass, because I think most people are in bonds and stocks and what have you, and I think they could be extremely vulnerable when, not if, interest rates rise.
How can our audience get in contact with you, John, if they choose to do so?
Absolutely. Just come to www.sprott.com, and if you got any questions, they'll get to me, and I'll see if I can answer.
John Embry, Chief Investment Strategist, Sprott Asset Management. Thank you, John, and until next time, my friend, be well.
Thank you very much, Patrick.
Take care.
You bet. See you later.